Hey everyone, welcome back to the channel. Today, we're diving into Chapter 17 of the Psychology of Money, titled The Reasonable Investor. In this chapter, Morgan Housel takes us on a journey to uncover the simple yet powerful truth that being a successful investor doesn't require genius-level strategies. It requires being reasonable. Housel emphasizes that the best investment approach is often the one that stays grounded, keeps emotions in check, and avoids the temptation to chase extraordinary results. If you've ever felt the pressure to get rich quick or been enticed by complex investment schemes, this chapter is a must-read. Let's explore why being a reasonable investor is the key to long-term success. Introduction to Chapter 17, The Reasonable Investor. Housel begins by challenging the conventional idea of what it takes to be a successful investor. Instead of trying to outsmart the market or predict the next big thing, he argues that the most successful investors are those who take a reasonable, long-term approach. But what exactly does being reasonable mean? For Housel, it's about consistency, patience, and staying within the bounds of what makes sense for you, given your own goals, risk tolerance, and circumstances. Core concepts from Chapter 17. Housel delves into a few critical lessons in this chapter. 1. Success doesn't require genius-level knowledge. The first myth Housel tackles is the idea that you need to be a genius or have insider knowledge to be a successful investor. In reality, consistency and common sense are far more important. Successful investing isn't about timing the market or picking the next big stock. It's about staying disciplined, keeping costs low, and focusing on long-term growth. Housel points out that the average investor doesn't need to know everything about the market. They just need to make reasonable decisions and avoid making impulsive, emotional moves. 2. Avoiding extreme risk. One of the key traits of a reasonable investor is their ability to avoid taking on extreme risk. There's a fine line between being bold and reckless. Successful investors recognize that taking on too much risk can wipe out years of gains and derail long-term success. Being reasonable means making decisions that align with your financial goals, while ensuring that the risks you take are manageable and within your control. 3. The power of compounding. Housel emphasizes the importance of compounding in investing, one of the most powerful tools available to investors. By focusing on slow, steady growth and giving your investments time to grow, you can harness the power of compounding to achieve substantial returns over the long term. Reasonable investors understand that compounding doesn't require making huge gains all at once. It's about consistent growth over time. 4. Ignore the hype. One of the most significant challenges investors face is the constant noise from media, market trends, and others pushing high-risk, high-reward schemes. Being a reasonable investor means tuning out the hype and sticking to your investment plan, even when the latest trend or stock is tempting. Housel argues that the most successful investors are those who remain calm in the face of market volatility and avoid jumping on every new trend. Storytelling moments. Housel uses several real-life examples and anecdotes to illustrate the points in this chapter. The tale of Warren Buffett. One of the most notable stories Housel shares is about Warren Buffett, who is widely regarded as one of the greatest investors of all time. What makes Buffett successful isn't some secret knowledge of the market. It's his disciplined, long-term approach to investing, his ability to avoid overpaying for stocks, and his commitment to sticking to what he knows. Buffett's success shows that even the most well-known investors prioritize reasonable, steady decisions over risky, high-stakes bets. The story of investors who lost it all. Housel also highlights the stories of investors who took huge risks, only to see their wealth evaporate during market crashes or downturns. These stories serve as warnings that investing in anything too volatile or risky can often result in major losses. The reasonable approach, according to Housel, is to diversify, stay calm, and stick to your plan, especially in tough times. Key takeaways. Here are the most important lessons from Chapter 17. 1. Reasonable over genius-level strategy. Success in investing doesn't require insider knowledge or extraordinary strategies. It's about making reasonable, well-thought-out decisions based on long-term goals and a solid understanding of risk. 2. Manage risk. Don't chase big wins. Avoid the temptation to take on extreme risks. A reasonable investor understands that long-term success is about balance, not chasing massive returns in a short period. 3. The power of compounding. Don't underestimate the power of small, consistent gains. Let your investments grow steadily over time and let compounding work its magic. 4. Ignore the noise. The market will always have noise, new trends, hot stocks, or sensational headlines. Focus on your own investment strategy and avoid reacting impulsively to the latest fad. Why it matters. Chapter 17 serves as a reminder that the most successful investors aren't those who try to beat the market. They're the ones who understand that consistency, patience, and a reasonable approach are key to long-term success. 1. It reduces anxiety. When you realize that successful investing doesn't require you to be a genius, it's easier to let go of the fear and anxiety of making the perfect decision. 2. It encourages discipline. Following a reasonable approach means avoiding the emotional highs and lows of the market and staying disciplined. It's about staying the course, even when the market is volatile. 3. It focuses on what matters. Focusing on what's truly important, long-term growth, reasonable risk, and a solid investment plan, helps you avoid being distracted by the noise and drama that often surround investing. Practical applications. Here's how you can apply the ideas from this chapter to your own investment strategy. 1. Define your investment strategy. Take the time to define your goals and understand your risk tolerance. A reasonable investor knows what they're working towards and adjusts their strategy accordingly. 2. Avoid trying to time the market. Rather than trying to pick the perfect time to buy or sell, focus on steady contributions to your investments over time. This reduces the stress of missing out on a perfect opportunity. 3. Stay calm during market volatility. When markets dip or rise unexpectedly, don't let your emotions drive your decisions. Stick to your plan and trust that reasonable, long-term investments will work out over time. 4. Ignore the fads. Resist the temptation to follow every market trend or buy into the latest hot stock. Instead, keep your focus on investments that align with your goals, risk tolerance, and financial plans. Expanding the conversation. This chapter challenges us to rethink what it means to be a successful investor. It's not about getting rich quickly or trying to be an expert in everything. It's about being reasonable, consistent, and disciplined. Call to action. If this breakdown resonated with you, be sure to like this video and share it with a friend who could benefit from these insights. And if you're new to the channel, don't forget to subscribe and hit the notification bell so you'll be the first to know when we break down the next chapter. Take care, and I'll see you in the next one.